Hey everyone, tonight we're diving into something that's going to completely change how you see every financial crisis, every war, every emergency declaration for the rest of your life. There's a pattern that repeats through history, a pattern so consistent, so profitable, and so hidden that once you see it, you can't unsee it. Banks create crises, then profit from the rescue. It happened in 1914. It happened in 2008. It's happening right now, and I'm going to show you exactly how it works. But before we step into this journey together, I'd love it if you could hit that subscribe button if you enjoy these deep dives into how money and power really work. And hey, I'm genuinely curious. Where are you watching from tonight? Your apartment in Seattle? A dorm room in Austin? Maybe you're winding down after a long day in Denver. Drop a comment below and let me know. I read every single one, and I absolutely love hearing from fellow economic history enthusiasts who want to understand the real patterns beneath the surface. Now get comfortable. Maybe dim those lights if you haven't already. Turn on some white noise if that helps you relax. Because over the next few hours, we're going on an incredible journey through 110 years of financial history. And by the end, you'll understand something that most people never see. You'll understand why the next crisis is coming, what emergency they'll use to justify it, and how you can position yourself before it happens. Ready? Let's begin. Picture this. It's 1914, and Europe's banking system is collapsing, not from war. The war hasn't started yet. The banks are dying from their own recklessness, from decades of overlending and speculation. Then something remarkable happens. War is declared in August, and suddenly the banking system that should have died is rescued instead. Normal rules are suspended overnight. Gold requirements disappear. Government guarantees flow to banks. And the crisis that had been building for years is instantly blamed on the war emergency, rather than banker greed. Now, you might think that's just one historical event, an interesting footnote. But here's what will blow your mind. That exact same pattern has repeated in every major crisis since 1914, the Great Depression in 1929, World War II and Bretton Woods in 1944, the Nixon shock in 1971, the 2008 financial crisis, the COVID pandemic in 2020, and the regional bank failures in 2023. Every single time, the same playbook. Every single time, banks profit while the public pays. Every single time, they emerge more powerful than before. The pattern is so consistent it appears scripted, and once you understand it, you'll see it everywhere. In every news headline about banking crises, in every emergency declaration, in every bailout disguised as systemic stability. The pattern repeats because it works. It transfers wealth from the many to the few, and nobody stops it because nobody sees it. Until now. Tonight, I'm going to show you the pattern in excruciating detail. Step by step, crisis by crisis, era by era. And you're going to see it so clearly that you'll wonder how you ever missed it. But I need you to understand something important before we dive deep. This isn't a conspiracy theory. This is pattern recognition. This is looking at the historical record and seeing what's actually there versus what the textbooks tell you. The documents exist. The numbers are public. The mechanisms are documented. We're not speculating. We're observing. And what we observe is a system that works exactly as designed. A system where crisis isn't a bug. Crisis is a feature. Crisis is the business model. So here's what we're going to do together tonight. First, we'll walk through the 1914 pattern in detail because that's where the playbook was created. You'll see exactly how a banking crisis became a war rescue operation. Then we'll move through each subsequent crisis, showing how the same mechanisms appear every single time. 1929, 1944, 1971, 2008, 2020, 2023. Each time I'll show you the pattern, and each time you'll see it getting bigger, bolder, and more brazen. But here's where it gets really interesting. As we move through history, you're going to notice something. The pattern isn't just repeating, it's accelerating. The time between crises is shrinking. The scale of bailouts is exploding. The consolidation of power is intensifying. And that tells us something crucial. The next crisis isn't some distant possibility. It's coming soon, very soon. And understanding the pattern is the only way to see it before it arrives. By the time we're done tonight, you'll understand more about how the financial system actually works than 99% of people. You'll be able to recognize the warning signs. You'll understand what the insiders are doing right now while everyone else sleeps. And you'll have the knowledge to position yourself accordingly. This isn't just history. This is the blueprint for what's coming next. And those who understand the pattern don't have to repeat its mistakes. Stay with me. This journey is worth it. Let's start at the beginning. Let's go back to 1914 and see how this whole pattern was born. Because everything that comes after flows from this moment. Everything modern financial crisis management learned its lessons from World War I. The mechanisms, the justifications, the wealth transfers, the power consolidations. It all starts here. And once you see how it worked in 1914, you'll recognize it instantly in every crisis that follows. The year is 1913, and behind closed doors at the Bank of England, officials are having emergency meetings. The reserve ratio has fallen to dangerous levels. Credit markets are seizing up. Gold is being hoarded. And bankers across Europe know something that the public doesn't. The entire system is on the verge of collapse. Not from any external shock, from internal fragility, from decades of reckless lending, from a gold standard that has become a straitjacket, from fractional reserve banking pushed to its absolute breaking point. Between 1870 and 1913, European banks had grown their deposit bases by roughly 400%. That's a fourfold increase. But gold reserves had increased by barely 80%. Can you see the problem building? The mathematics of this imbalance created a ticking time bomb. Every banking executive understood it, but nobody dared acknowledge it publicly, because acknowledging it would trigger the very panic they were trying to prevent. So they maintained the fiction. They kept the accounting games going, and they hoped something would change before the inevitable collapse arrived. The Rothschild family, with branches spanning London, Paris, and Vienna, were coordinating their responses to the deteriorating conditions they could see spreading across the continent. Their private correspondence from 1913 shows growing alarm. They were quietly reducing exposure to the riskiest loans. They were increasing gold holdings. They were preparing for a crisis they saw as inevitable. The smartest money in Europe was running scared. And that should have been everyone's first warning sign. JP Morgan's partners were sending private warnings to the architects of the newly proposed Federal Reserve System in America. The panic of 1907 had convinced American banking leaders that the United States needed a central bank, but Morgan's partners were watching Europe with growing concern. If the European banking system collapsed, American banks would be dragged down with it. The Federal Reserve, still being designed in 1913, needed to be operational before the European situation deteriorated further. This urgency was being communicated in private meetings that the public never saw. The warning signs were visible to anyone with access to the real numbers. Interbank lending rates began spiking in early 1914. Banks were growing increasingly reluctant to lend to each other. Major banks were quietly liquidating questionable assets before markets could realize how worthless they were. Insurance companies started refusing to underwrite certain bank bonds. Wealthy clients who maintained close relationships with senior bankers received private advice to diversify out-of-bank deposits. The insiders knew, they always know, and they always position themselves before the public understands what's coming. By July 1914, The situation had deteriorated beyond anything bankers had previously experienced. The Bank of England's reserve ratio fell to 26%, approaching the minimum level needed to maintain gold convertibility. The London Stock Exchange saw panic selling in late July. On July 27th and 28th, shares fell between 5% and 10% across all sectors. The exchange's settlement system began experiencing problems. There were so many transactions that the administrative machinery couldn't process them. The infrastructure was breaking down under the strain. Can you imagine the fear in those trading rooms? On July 30th, the London Stock Exchange Council made an extraordinary decision. The exchange would close the next day. This was unprecedented. The London Stock Exchange had operated continuously through wars, crises and panics for over a century. Its closure signaled that the situation had moved beyond anything the exchange's mechanisms could handle. The New York Stock Exchange closed on the same day. Stock exchanges in Paris, Berlin, Vienna and other European capitals quickly followed. By August 1st, virtually every major stock exchange in the world had closed. This had never happened before in financial history. Credit markets froze completely. Banks stopped lending to each other overnight. The financial system was paralyzed. As war was declared in early August, depositors across Europe rushed to withdraw their funds. Bank runs began in Austria, Germany, France, and Britain. The gold reserves of every major European bank dropped precipitously. At the rate gold was being withdrawn, all central banks would exhaust their reserves within 2 weeks. When that happened, currencies would become worthless and the entire monetary system would collapse. This was the moment of maximum danger. The banking system of Europe was hours away from complete failure. But something remarkable happened instead. Within days, normal rules that had governed banking for generations were suspended across Europe and America. The speed and coordination of these changes is remarkable. It suggests that plans had been prepared in advance, waiting only for the political justification to implement them. Let me show you exactly what happened. The gold standard was abandoned almost overnight. Britain passed the Currency and Banknotes Act on August 5th, just 1 day after declaring war. This revolutionary legislation allowed the Treasury to issue paper currency backed not by gold but by government credit. Think about what just happened there. The foundation of the entire monetary system, the thing that had made British currency trusted worldwide for centuries, was eliminated in a single day. A system that had governed finance for generations was gone overnight, and it was sold as a temporary war emergency measure. But here's the key lesson you need to remember. The temporary became permanent, just like it would in every crisis that followed. Stock exchanges closed for months. London didn't reopen until January 1915. During those months, banks couldn't be forced to mark their securities to market value. The illusion of solvency was maintained through market closure. Debt moratoria were declared across the continent. All those failing loans that had been hemorrhaging losses were suddenly frozen rather than coming due. Britain declared a general moratorium on August 2nd, before even declaring war. France declared an even more comprehensive moratorium on August 1st. The entire structure of commercial law was placed in suspension. Banks didn't have to pay out deposits. Borrowers didn't have to repay loans. Everything was frozen in place. The crisis was papered over, not solved. Government guarantees extended to the banking sector completed the rescue operation. The British government agreed to provide taxpayer guarantees against any losses incurred by the Bank of England. Chancellor David Lloyd George announced that the government would indemnify the Bank of England for any losses on commercial bills. Taxpayers were backstopping the entire banking system. Private risk had been socialised. Banks could make loans, knowing that if borrowers defaulted, the government would absorb the losses. Can you see the moral hazard being created? New currency was printed in massive quantities. Britain's money supply expanded from £288 million in 1914 to £531 million by 1918, an 84% increase in just 4 years. Germany's money supply increased sevenfold. This inflation transferred wealth from savers to banks. Your savings lost half their value while banks' debts were inflated away. The war provided the perfect excuse for every pre-existing problem on bank balance sheets. Failed colonial loans became patriotic investments in empire defense. Illiquidity became supporting the war effort. Every bad decision was suddenly justified by war necessity. But here's the real transformation. Governments became captive customers of the banking system. Nations needed immediate massive loans for mobilization. Banks became the sole source of war financing. This reversed the traditional power relationship. Governments couldn't let banks fail because losing their lenders meant losing the war. Banks gained unprecedented leverage over sovereign debt. In the first 6 months of the war, the British government borrowed over £350 million from the banking system. This was more than the entire government budget for a normal peacetime year. While generals planned troop movements, bankers orchestrated something far more permanent, the largest balance sheet laundering operation in modern history. Banks held billions in questionable private debt that had been deteriorating for years. Failed railroad ventures, speculative real estate loans, colonial projects that would never produce returns. Under normal circumstances, banks would have to write off these losses. Shareholders would bear the costs. But the war prevented this cleansing process. Banks offered governments a solution. They would exchange their risky private loans for newly issued government war bonds. A bank holding 100 million marks in defaulted Ottoman railway loans would exchange these for German war bonds. The bank's balance sheet improved immediately. Where it once held a non-performing loan, it now held a government bond paying interest. The losses didn't disappear. They were transferred to the government. Future taxpayers would service those bonds. Deutsche Bank's failing Ottoman railway loans became German war bonds backed by future reparations that never materialized. British banks converted their massive South American exposure into what was repackaged as empire defense financing. French banks exchanged billions in bad Russian debt for French government obligations. The scale was staggering. The British government alone provided some £200 million to banks, representing roughly 9% of national GDP. In modern terms, that's equivalent to the US government providing approximately $2 trillion in direct bank support. Germany provided similar support proportional to its economy. The pattern was universal. Governments everywhere stepped in to prevent banking collapse, and the cost was borne by future generations who had no voice in the decision. Democracy was suspended for banking rescue. Banks emerged from 1914 and 1915 with cleaner balance sheets than they had maintained in decades. New accounting standards introduced under war emergency rules allowed creative categorization of assets. Assets could be carried at par value regardless of market prices. Government bonds were always valued at face value, even if they traded at steep discounts. The accounting fictions made banks look solvent while hiding massive underlying losses. These wartime emergency measures were supposed to be temporary. They became permanent. The precedent set in 1914 echoes through every subsequent crisis. The winners could be measured in concrete numbers. JP Morgan and Company saw its assets grow from $550 million in 1913 to $1.2 billion by 1919. Britain's banking system consolidated from 38 major institutions in 1913 to just 5 dominant banks by 1920. These Big Five would control British finance for generations. Federal Reserve member banks in America tripled their deposit base during the war years. The largest banks grew even faster. They financed allied purchases, underwrote government bonds, and expanded internationally. The war made them giants. The losers bore costs that would compound for decades. Citizens holding pre-war currency savings watched inflation destroy 50 to 90% of their purchasing power. A German worker who had saved 10,000 marks by 1914 found that by 1920, those marks might buy a bicycle. The savings of a lifetime were destroyed. Thousands of small regional banks failed or were absorbed by giants. Entire nations found themselves perpetually indebted to a banking system that had been on the verge of collapse just years earlier. The power inversion was total and seemingly permanent. Now, here's what I need you to understand before we move forward. What happened in 1914 wasn't a one-time emergency response. It was the creation of a playbook, a template that would be used again and again. Let me show you the pattern clearly, so you can recognize it in every crisis that follows. First, banks overlend and create instability through their own recklessness. Second, a crisis threatens their existence. Third, an emergency provides political cover. Fourth, normal rules are suspended and public resources rescue private institutions. Fifth, banks emerge larger and more powerful while the public bears the costs. Sixth, the system becomes more concentrated and fragile, seeding the next crisis. This is the pattern. This is the playbook. And you're about to see it repeat in 1929, in 1971, in 2008, in 2020, and in 2023. The details change, the scale expands, but the pattern remains identical. Banks create crisis. Emergency justifies intervention. Public pays. Banks profit. Power consolidates. And it happens again. Now, I know we're about 20 minutes in, and you might be thinking this is just interesting history. But stay with me, because what I'm about to show you is how this pattern has repeated through every major crisis for over a century, and how it's building toward the biggest crisis yet. The question you should be asking yourself right now is, if the pattern worked so perfectly in 1914, why wouldn't they use it again? And the answer is, they did. 15 years later, in 1929, they ran the exact same playbook, but bigger, bolder, and with even more devastating consequences for ordinary people. Let's walk through how the pattern repeated in the Great Depression, because this is where you'll really start to see it. This is where the template becomes undeniable. Picture America in the 1920s, the Roaring Twenties, jazz, flappers, and endless prosperity. Everyone from shoeshine boys to millionaires was playing the stock market. Credit was flowing like water. People were buying stocks on margin, borrowing against their homes, convinced that prosperity was permanent. The newspapers called it the new economy. Politicians promised that boom and bust cycles were a thing of the past. Technology was going to change everything forever. Does any of this sound familiar? It should, because we're seeing the exact same dynamics today. But beneath the surface, the same vulnerabilities were building. Banks were lending money to anyone with a pulse. Speculation wasn't just encouraged, it was celebrated as patriotic. The Federal Reserve kept interest rates artificially low to stimulate growth. And just like in 1913, the smart money knew what was coming. Joseph Kennedy, father of JFK, famously sold all his stocks in early 1929 after getting stock tips from a shoeshine boy. Bernard Baruch, a wealthy financier, liquidated his positions before the crash. The insiders always know. They always position themselves before the public understands. October 1929 arrived, and the crash came exactly as the insiders had anticipated. Between October 24th and October 29th, the stock market lost nearly half its value. Fortunes built over decades vanished in days. But here's what most people don't know. The crash didn't cause the Great Depression. The crash was the symptom of underlying banking fragility that had been building for years. Just like 1914, the crisis was already there. The crash just made it visible. And just like 1914, the response followed a familiar pattern. Between 1929 and 1933, approximately 9,000 American banks failed. Think about that number, 9,000 banks. That's not a crisis. That's a complete meltdown of the banking system. But here's the crucial detail. Not all banks failed. The largest, most connected banks survived. JP Morgan survived. Chase National Bank survived. National City Bank survived. They didn't just survive. They used the crisis to absorb their failed competitors at bargain prices. The consolidation that had begun in 1914 accelerated dramatically. The Federal Reserve's response is particularly revealing. Instead of providing liquidity to prevent bank failures, the Fed actually raised interest rates into the crash. In October 1929, as markets were collapsing, the Fed increased rates. This made the crisis worse, not better. Was this incompetence? Or was it deliberate? Because the effect was to ensure that weak banks failed, while strong banks could acquire them cheaply. The pattern suggests design, not accident. Just like 1914, crisis created opportunity for consolidation. By 1933, the banking crisis had reached its peak. President Franklin Roosevelt declared a bank holiday on March 6, 1933. All banks in the United States were ordered to close. For 4 days, Americans couldn't access their money. When banks reopened, only those deemed sound by government inspectors were allowed to operate. This forced consolidation eliminated thousands of small banks while protecting large institutions. The Emergency Banking Act passed on March 9th, just 3 days after the bank holiday began. Notice the speed. Emergency legislation that fundamentally restructures banking passes in 3 days, just like 1914. But Roosevelt went further. On April 5, 1933, he signed Executive Order 6102. This order required all Americans to surrender their gold coins, gold bullion, and gold certificates to the Federal Reserve by May 1st. Failure to comply was punishable by up to 10 years in prison and a $10,000 fine. Think about what this means. The government confiscated gold from its citizens at $20.67 per ounce, then immediately revalued gold to $35 per ounce. This was a 69% devaluation of the dollar overnight. Wealth was transferred from gold holders to the government and banks. The Glass-Steagall Act of 1933 officially enshrined the too big to fail doctrine. The act separated commercial banking from investment banking, but more importantly, it created the Federal Deposit Insurance Corporation. Government now explicitly guaranteed bank deposits. This sounds good for depositors, right? But think about the moral hazard. Banks can now take unlimited risks because deposits are guaranteed. If they profit, shareholders win. If they fail, taxpayers cover the losses. The privatization of profits and socialization of losses became official policy. Let's review the 1929 pattern and compare it to 1914. Banks overlend in the boom. Check crisis threatens the system. Check emergency powers are invoked. Check gold standard is suspended, 1914. Or gold is confiscated, 1933. Check government guarantees transfer risk to public. Check smaller banks fail, while large banks absorb them. Check the system emerges more concentrated and powerful. Check the pattern is identical. The scale is larger, but the mechanisms are the same. Do you see it yet? This isn't coincidence. This is replication. The winners from the Great Depression were the same institutions that won from World War I. JP Morgan emerged even more dominant. The Morgan partners had personal relationships with Roosevelt administration officials. Henry Morgenthau Jr., Roosevelt's Treasury Secretary, worked closely with Wall Street banks to design the New Deal banking reforms. The reforms protected large banks while eliminating small competitors. By 1940, the concentration of banking assets in the largest institutions had increased dramatically. The crisis had been used for consolidation. Again, the losers were ordinary Americans. Unemployment reached 25%. Millions lost their homes, their farms, their savings. The wealth gap that had narrowed slightly after World War I exploded again. By 1933, wealth inequality exceeded even the robber baron era of the 1890s. And here's the crucial point. This inequality wasn't an unfortunate side effect of the Depression. It was the intended outcome of the banking rescue. Wealth was transferred from the many to the few through the exact mechanisms we saw in 1914. Crisis, emergency, bailout, consolidation. The pattern repeats. Now, you might be thinking, okay, the pattern repeated twice. That's interesting, but not conclusive. Maybe it's just how societies respond to crisis. Random events that happen to look similar. But stay with me, because we're about to see the pattern repeat again. And this time, it goes global. World War II and the Bretton Woods Conference of 1944 would take the banking playbook and scale it to the entire world. What had been national rescues in 1914 and 1929 would become global domination in 1944.
Wow.
We're about 40 minutes in now, and I want to make sure you're seeing the pattern clearly. So let me summarize what we've learned so far. In 1914, banks were collapsing from their own recklessness. War provided the emergency justification for rescue. Normal rules were suspended. Gold standard was abandoned temporarily. Government guarantees protected banks. Bad private debts became public obligations. Banks emerged stronger. In 1929, the pattern repeated. Banks overlent. Crash exposed the fragility. Emergency banking powers were invoked. Gold was confiscated. Deposits were guaranteed. Small banks failed. Large banks consolidated. Same pattern, bigger scale. Now watch what happens in 1944. Because this is where the pattern goes, from national to global. This is where American banks, having dominated their domestic market, expand their reach to the entire world. The mechanism. World War II and the Bretton Woods Conference. Let me show you how it worked. World War II, like World War I, required massive financing. And just like World War I, banks positioned themselves as the essential intermediaries. American banks lent to all sides through various mechanisms. Officially neutral until 1941, American banks were financing the war from the beginning. But here's what makes World War II different from World War I. By 1944, it was clear the Allies would win. It was also clear that Europe would emerge from the war completely devastated and deeply indebted. American bankers saw an opportunity, not just to rescue themselves from bad loans like in 1914, but to restructure the entire global monetary system in their favor. In July 1944, delegates from 44 nations gathered at Bretton Woods, New Hampshire. Officially, they were designing a new international monetary system to prevent future wars. In reality, they were creating a system of global banking dominance. The Bretton Woods Agreement established the US dollar as the world's reserve currency. Other currencies would be pegged to the dollar. The dollar would be convertible to gold at $35 per ounce. But here's the key. Only foreign central banks could convert dollars to gold. American citizens couldn't. This created a system where the United States could print dollars to buy real goods from other countries, and those countries had to hold dollars or hold gold. But holding gold was inconvenient for international trade, so they held dollars. And those dollars flowed back into American banks. Think about the genius of this system from a banking perspective. American banks could lend dollars internationally. Those dollars would be used to purchase goods and services. The dollars would return to American banks as deposits. The banks could lend those same dollars again. The multiplier effect was extraordinary, and it was all backstopped by gold that the US had accumulated during the war. By 1945, the United States held approximately 70% of the world's monetary gold. This gold backed the dollar. The dollar backed international trade, and American banks intermediated everything. The International Monetary Fund and World Bank were created at Bretton Woods. Officially, these institutions would provide stability and development financing. In reality, they became enforcement mechanisms for banking interests. Countries that needed IMF loans had to implement structural adjustment programs. These programs required privatization of state assets, elimination of capital controls, and opening markets to foreign banks. The IMF became the international repo man. Nations that couldn't pay their debts to banks would be forced to sell their assets. The pattern from 1914 and 1929 had gone global. The Marshall Plan, announced in 1947, was sold as American generosity, helping rebuild Europe. But look at the structure. Marshall Plan funds were loans, not grants. European countries received dollars to purchase American goods. Those dollars returned to America. The goods went to Europe. But Europe now owed dollars to American banks. It was the same wealth transfer mechanism we saw in 1914, but on a continental scale. Europe was indebted to America just like it had been after World War I. The only difference was the scale and the permanence of the arrangement. By 1950, the pattern was complete. American banks dominated global finance. The dollar was the universal currency. The International Monetary Fund and World Bank enforced banking interests internationally. Europe was indebted and dependent, and all of this was sold as preventing future wars and promoting prosperity. But look at the reality. Banking crises hadn't decreased. They had been exported. Countries across Latin America, Africa, and Asia would spend the next 50 years in recurring debt crises, always resolved through IMF intervention that protected bank creditors while devastating local populations. The 1944 pattern took the 1914 playbook and scaled it globally. Crisis. World War II destroyed Europe. Emergency. Need to rebuild and prevent future war. Intervention. Bretton Woods creates dollar hegemony. Outcome? American banks dominate global finance. Consolidation. IMF and World Bank enforce bank interests internationally. Same pattern. Global scale. And here's what you need to understand. This system is still in place today. The dollar is still the reserve currency. The IMF still enforces bank interests. The World Bank still makes loans that countries can't repay. The 1944 system is the foundation of modern global finance. But there was a problem with the Bretton Woods system. That gold backing. That promise that dollars could be converted to gold at $35 per ounce. Because America had been printing dollars far in excess of its gold reserves. By the 1960s, the math didn't work anymore. Foreign central banks held more dollars than America had gold to redeem them. France, under President Charles de Gaulle, started demanding gold for dollars. Other countries watched nervously. If everyone demanded gold simultaneously, the system would collapse. Just like 1914, the gold standard had become a constraint again. And just like 1914, it would be abandoned. But this time, permanently. We're about an hour into our journey now, and I know we've covered a lot. You've seen the pattern in 1914, in 1929, in 1944. Each time, banks create instability. Crisis threatens them. Emergency justifies intervention. Public resources rescue private institutions. Banks emerge more powerful. The system becomes more concentrated. And the stage is set for the next crisis. But here's what you need to understand. We're not done. The pattern hasn't stopped. In fact, it's accelerating. And in the next section, we're going to see something that changes everything. We're going to see the moment when the last constraint on banking power was removed. The moment when the gold standard was permanently abandoned. The moment when money became pure government promise with no tangible backing at all. August 15th, 1971. The Nixon shock. And once you understand what happened that day, you'll understand why everything that's happened since, every crisis, every bailout, every inflation, has been possible. This is where the pattern takes a dark turn. This is where it becomes unstoppable. Stay with me. The 1960s were a time of massive government spending. President Lyndon Johnson's Great Society programs promised to eliminate poverty. The Vietnam War required enormous military expenditure. The United States was trying to finance both guns and butter simultaneously, and it was doing this by printing dollars. Lots of dollars. But remember, under Bretton Woods, foreign central banks could exchange those dollars for gold at $35 per ounce. And they were starting to notice that America was printing far more dollars than it had gold to back them. France was particularly aggressive. President Charles de Gaulle, never a fan of American dominance, started converting dollars to gold and having the gold physically shipped to Paris. By 1971, the situations had become critical. Foreign central banks held dollars worth far more than America's entire gold reserve. If they all demanded conversion, the gold would be gone in days. America would default on its promise. The dollar would collapse. International trade would freeze. And American banks would face catastrophic losses on their international loans. The constraint of gold convertibility was about to break the system. Again, on August 15th, 1971, President Richard Nixon went on television with a shocking announcement. The United States was temporarily suspending the convertibility of dollars into gold. Foreign central banks could no longer exchange their dollars for American gold. The gold window was closed. Nixon framed this as a temporary measure to stop speculators from attacking the dollar. But think about what really happened. The United States had promised that dollars were as good as gold. Foreign nations had accepted dollars based on that promise. Now America was breaking that promise unilaterally. This was technically a default, the largest default in history. But it wasn't called a default. It was called a suspension, a temporary measure. Sound familiar? Just like 1914, when the gold standard suspension was supposed to be temporary. But we know how that turned out. The 1971 suspension was permanent. The gold window has never reopened. It's been 53 years. The temporary measure is eternal. And that tells us everything about how the pattern works. Emergency measures become permanent. Always. But here's what the Nixon shock really meant for banks. The last constraint on money creation had been removed. Under the gold standard, even the limited version that existed after 1944, there was a theoretical limit to how many dollars could be created. That limit was gone. Money was now pure fiat, pure government promise. And governments, as we've seen repeatedly, will do whatever banks need them to do during crisis, which meant banks now had access to unlimited money creation. The implications were staggering. Without gold backing, inflation became the primary mechanism of wealth transfer. When government prints money, it creates inflation. Inflation reduces the real value of fixed debts. Banks are large debtors because they owe money to depositors. So inflation benefits banks while harming savers. It's a hidden tax, a silent theft. And it's completely legal. In fact, it's monetary policy. After 1971, this mechanism became the preferred tool for rescuing banks. Print money, create inflation, transfer wealth from savers to debtors, all while claiming to be promoting economic growth. But there was still a problem. If the dollar wasn't backed by gold, why would anyone accept it? The answer came in 1973 to 1974, the petrodollar system. Henry Kissinger negotiated deals with Saudi Arabia and other OPEC nations. They would sell oil exclusively in dollars. In exchange, the United States would provide military protection and sell them weapons. This was genius. Every country needed oil. To buy oil, they needed dollars. To get dollars, they had to sell goods to America or borrow from American banks. The dollar was now backed not by gold, but by oil, and more importantly, by American military power. The 1971 pattern took the playbook to a new level. The constraint: gold convertibility limits money creation. The problem: America can't finance spending and maintain gold backing. The emergency: speculative attacks on the dollar. The solution: abandon gold standard permanently. The outcome: unlimited money creation capability. The consolidation: dollar dominance maintained through oil and military power. Same pattern, evolved application. And here's the crucial lesson: each iteration of the pattern removes more constraints. 1914 removed gold temporarily. 1933 confiscated gold from citizens. 1971 removed gold backing entirely. Each crisis loosens the rules permanently. The implications of the 1971 shift took years to fully manifest. But by the late 1970s, the results were clear. Inflation reached double digits. The dollar lost over half its purchasing power between 1971 and 1980. But banks were fine. They had borrowed at low fixed rates and repaid in inflated currency. They had converted their deposits, which lost value from inflation, into loans that maintained nominal value. The wealth transfer was enormous, and it was completely legal. This was the new pattern. Instead of visible bailouts like 1914 and 1933, the rescue came through inflation. Hidden, gradual, but just as effective. By 1980, the pattern had evolved significantly from its 1914 origins. The mechanisms were more sophisticated. The consolidation was more complete. The international dimension was more extensive. But the core remained identical. Banks create instability. Crisis threatens them. Emergency justifies intervention. Public pays. Banks profit. System concentrates. And it happens again. We've now seen the pattern repeat 4 times. 1914, 1929, 1944, 1971. 4 different crises, 4 different justifications, identical outcomes. The pattern is undeniable, but we're not done. Because the pattern was about to repeat again, and this time, in a way that would make all previous bailouts look small. We're approaching the 90-minute mark, and this is where things get really interesting. Because everything we've discussed so far, every pattern repetition from 1914 through 1971, was building toward what I'm about to show you. The 2008 financial crisis. This is where the pattern reaches its apotheosis. This is where all the mechanisms we've traced through a century of crises combine into the largest bailout in human history. And here's the shocking part. Most people think they know what happened in 2008. They know about the $700 billion TARP bailout. But that's just the visible part. The real bailout was $29 trillion. Let me show you. The 2008 crisis didn't start in 2008. It started building in the early 2000s, right after the dot-com bubble burst in 2000. The Federal Reserve, under Alan Greenspan, responded to the dot-com crash by lowering interest rates to 1%. This created an ocean of cheap money looking for returns. Banks directed that money into housing. Mortgage lending exploded. Housing prices soared, and banks created increasingly exotic financial instruments to profit from the boom. Subprime mortgages, Alt-A loans, negative amortization, no-doc loans. They were lending to anyone with a pulse. Sound familiar? It's the same pattern from the 1920s. Easy credit, speculation, inevitable crash. But 2008 had a twist. Banks had figured out how to make bad loans and immediately sell the risk. They originated mortgages, packaged them into securities called mortgage-backed securities, sold those securities to investors, and collected fees on every transaction. This was supposed to disperse risk across the financial system. In reality, it concentrated risk in ways nobody fully understood. Because banks didn't just sell the mortgages, they created derivatives based on the mortgages. Credit default swaps, collateralized debt obligations, synthetic CDOs. The notional value of derivatives exploded into the hundreds of trillions. The entire global financial system had become a leveraged bet on American housing prices continuing to rise forever. When housing prices stopped rising in 2006 and began falling in 2007, the house of cards started to collapse. Subprime mortgages began defaulting at alarming rates. Mortgage-backed securities lost value. Banks holding these securities faced losses. But worse, the derivatives market began to freeze. Nobody knew who was exposed to what. Counterparty risk exploded. Banks stopped lending to each other. Does this sound familiar? It's July 1914 again. Credit markets freezing. Banks refusing to lend to each other. But now with derivatives adding an additional layer of complexity and danger. Bear Stearns failed in March 2008. J.P. Morgan acquired it with Federal Reserve assistance. The Fed provided $29 billion to facilitate the deal. Lehman Brothers failed in September 2008. This failure was allowed, supposedly to teach banks a lesson about moral hazard, but the lesson taught was different than intended. Lehman's failure nearly brought down AIG, which had sold credit default swaps to banks worldwide. If AIG failed, every major bank would face catastrophic losses. So AIG was rescued, with $182 billion in government money. The lesson: be so interconnected that your failure threatens everyone. Then you'll definitely be rescued. The TARP program, the Troubled Asset Relief Program, authorized $700 billion to purchase troubled assets from banks. This was sold to Congress and the public as preventing economic collapse. You remember the rhetoric? Treasury Secretary Henry Paulson, former CEO of Goldman Sachs, told Congress that without TARP, ATMS would stop working. Food would disappear from grocery stores. Civilization would collapse. The fear-mongering worked. Congress passed TARP in October 2008. But here's what most people don't know. TARP was just the visible part of the bailout, the tip of the iceberg. In 2011, Bloomberg News won a lawsuit against the Federal Reserve forcing disclosure of crisis lending. The documents revealed something shocking. Between 2007 and 2010, the Federal Reserve provided $29 trillion in emergency lending to banks. Not $700 billion, $29 trillion. Let me repeat that because it's important. $29 trillion. This was provided through various emergency facilities with names like the Term Auction Facility, the Primary Dealer Credit Facility, the Term Securities Lending Facility. The facilities were technical, the amounts were staggering, and it was all done with minimal public disclosure or oversight. Who got the money? Every major bank. Citigroup, $2.5 trillion. Morgan Stanley, $2.04 trillion. Bank of America, $1.3 trillion. But also foreign banks. European banks that had bought American mortgage securities got Federal Reserve support. The Swiss bank, UBS, received over $700 billion. The German Deutsche Bank received hundreds of billions. The French Société Générale received support. American taxpayers, through the Federal Reserve, were bailing out the entire global banking system. The 1944 pattern of global banking consolidation was being reinforced through crisis. Now, let's review the 2008 pattern and compare it to every previous iteration. Banks overlend. Check, they created a housing bubble through reckless mortgage lending. Crisis threatens system. Check, Lehman's failure nearly brought down the entire global financial system. Emergency declared. Check, TARP and Fed facilities were all justified as emergency measures. Normal rules suspended. Check, Fed lent against collateral it would never accept in normal times. toxic assets moved to government balance sheet. Check. The Fed's balance sheet expanded from under $1 trillion to over $4.5 trillion. Banks emerged stronger. Check. The largest banks acquired failed competitors and became even more dominant. The pattern is identical to 1914, to 1929, to 1944, to 1971. But the scale is vastly larger. In 1914, Britain provided 9% of GDP in bank support. In 2008, the United States provided support equivalent to roughly 30% of GDP when you include TARP, Fed facilities, FDIC guarantees, and other programs. The mechanisms are the same. The justification is the same. The outcome is the same. Crisis becomes opportunity for consolidation and increased banking power. The pattern repeats, but accelerates. The 2008 winners were the same institutions that always win. J.P. Morgan Chase acquired Bear Stearns and Washington Mutual, becoming the largest bank in America. Bank of America acquired Countrywide Financial and Merrill Lynch. Wells Fargo acquired Wachovia. The crisis that supposedly threatened the banking system actually made the largest banks bigger, more powerful, and more systemically important. By 2010, the 5 largest American banks controlled 45% of all banking assets, up from 35% before the crisis. Too big to fail had become bigger and more fail-proof. The losers were millions of Americans. 10 million lost their homes to foreclosure. Unemployment reached 10%. Retirement savings were devastated as stock markets crashed. But here's the crucial detail. While average Americans lost $16 trillion in wealth, while homeowners lost their houses, while workers lost their jobs, the banks were made whole. Every dollar they lost on bad mortgages was replaced by taxpayer money. And then, in perhaps the most obscene detail, bank executives paid themselves bonuses. In 2009, after receiving billions in bailout funds, Goldman Sachs paid $16.2 billion in bonuses. The crisis they created made them richer. Now, before we move on, I want you to recognize something critical about where we are in the story. We've traced the pattern through 1914, 1929, 1944, 1971, and 2008. 5 iterations over 94 years. Each time, the same playbook. Each time, bigger scale. Each time, more brazen. Each time, more wealth transferred from public to banks. And each time, the system emerges more concentrated and more fragile. But here's what should terrify you. The pattern is accelerating. The time between crises is shrinking. 1914 to 1929 was 15 years. 1929 to 1944 was 15 years. 1944 to 1971 was 27 years. 1971 to 2008 was 37 years. But 2008 to the next crisis, only 12 years. And that next crisis was 2020. The pattern is speeding up. So here we are, just past the 90-minute mark. And this is where most documentaries about banking crises would end. They'd tell you about 2008, maybe mention Dodd-Frank reform, and leave you with some vague hope that lessons were learned and it won't happen again. But I'm not going to do that. Because the pattern didn't stop in 2008. It repeated again in 2020. And it repeated again in 2023. And it's building again right now for the next iteration. And this is the most important part of our entire journey tonight. Because this is about the future. This is about what's coming. This is about you. March 2020. A new virus is spreading globally. Governments respond with lockdowns. The economy shuts down. Stock markets crash. Credit markets freeze. And the Federal Reserve responds with the most aggressive intervention in its history. But here's what you need to understand. The crisis wasn't caused by COVID. The crisis was already building before COVID. In September 2019, 6 months before anyone had heard of coronavirus, something strange happened in the overnight lending market called the repo market. Interest rates spiked from 2% to 10% in a single day. This meant banks didn't trust each other enough to lend overnight. Sound familiar? The Federal Reserve intervened in September 2019 with hundreds of billions in repo lending to prevent a credit crisis. This was 6 months before COVID. The financial system was already showing signs of stress. The same signs we saw in July 1914, the same signs we saw in 2007, rising counterparty risk, credit markets seizing, banks hoarding liquidity. The crisis was building. COVID didn't cause the financial crisis. COVID provided the perfect political cover for the bailout that was already necessary, just like World War I provided cover for the 1914 bailout. When markets crashed in March 2020, the Fed's response was immediate and massive. Interest rates went to zero within days. The Fed announced unlimited quantitative easing, not $500 billion, not $1 trillion. Unlimited. The Fed would buy as many treasuries and mortgage-backed securities as necessary to keep markets functioning. The Fed also announced for the first time in history that it would buy corporate bonds. Let me emphasize this. The Federal Reserve, which is supposed to be a lender of last resort for banks, was now directly financing corporations. This crossed a line that had been considered absolute, but crisis provides permission for the previously unthinkable. The numbers are staggering. The Fed's balance sheet expanded from $4 trillion in February 2020 to $9 trillion by early 2022. That's $5 trillion in asset purchases in less than 2 years. For context, it took the Fed nearly a century to build a $4 trillion balance sheet. It doubled that in 24 months. Meanwhile, Congress authorized trillions in spending. The CARES Act alone was $2.2 trillion. Subsequent relief packages added trillions more. The money supply, measured by M2, increased by over 25% in a single year. That's the fastest monetary expansion in American history outside of wartime. Who benefited? Banks, obviously. They received Fed support that kept their assets from collapsing in value, but also corporations. Large companies with access to bond markets got Fed support. The wealthy, who own most financial assets, saw their wealth explode as stock markets reached all-time highs despite 15% unemployment. Billionaires added over $1 trillion to their collective wealth during 2020. Think about that. A pandemic that devastated millions of working people made billionaires $1 trillion richer. That's not an accident. That's the pattern working exactly as designed. The 2020 pattern is now sickeningly familiar. Crisis, pandemic, emergency, need to prevent economic collapse, intervention, Fed prints $5 trillion, Congress spends $5 trillion. Outcome, financial assets inflate, wealthy benefit. Consolidation, small businesses died, large corporations got bigger. Same pattern, new justification, identical result, and the speed is what should worry you. We went from 2008 crisis to 2020 crisis in just 12 years. The pattern is accelerating. The interventions are getting larger. The wealth transfers are getting more blatant. And nobody stops it because by now, this is just how the system works. But we're not done. Because the pattern repeated again in 2023, March 2023. Silicon Valley Bank fails after a run by depositors who realized the bank had massive unrealized losses on its bond portfolio. Signature Bank fails. First Republic Bank fails. The banking system faces its most significant crisis since 2008. And the response? Immediate and massive. The FDIC guaranteed all deposits at failed banks, even those above the $250,000 insurance limit. This was explicitly breaking the law. Deposit insurance covers up to $250,000, period. But in an emergency, laws don't matter. The guarantee was made, all depositors made whole. The Federal Reserve created a new facility called the Bank Term Funding Program. This facility allowed banks to borrow against their underwater bonds at par value, ignoring market losses. Think about what this means. Banks held bonds that had lost value due to rising interest rates. If they sold these bonds, they'd have to recognize losses. The BTFP allowed them to borrow against the bonds as if they were still worth full value. This is accounting fraud enabled by regulatory forbearance. It's hiding losses with Federal Reserve support. And it's the exact same mechanism we saw in 1914 when wartime accounting rules allowed banks to hide insolvency. JP Morgan Chase acquired First Republic Bank with FDIC assistance. Again, the largest bank in America getting even larger by acquiring a failed competitor with government support. The pattern is so consistent, it's almost boring at this point. Crisis, emergency, bailout, consolidation. Repeat. But here's what makes 2023 particularly ominous. The crisis happened despite all the reforms supposedly implemented after 2008. Dodd-Frank, stress tests, higher capital requirements, living wills, all of it. And banks still failed. And the response was still bailout and consolidation, because the pattern doesn't change. The pattern is the system. Now, let me show you where we are right now. As of 2024, banks are sitting on approximately $620 billion in unrealized losses on their bond portfolios. These losses aren't recognized on balance sheets because of accounting rules that allow hold-to-maturity classification. But the losses are real. If depositors lose confidence and demand withdrawals, banks would have to sell bonds at losses. This would reveal insolvency. The Fed's BTFP is hiding this problem temporarily. But the problem is still there. Just like the problem was there in 1913, hidden until July 1914 made it visible. Commercial real estate is collapsing. Office buildings sit empty as remote work becomes permanent. Shopping malls die as e-commerce dominates. Banks hold hundreds of billions in commercial real estate loans. As properties lose value and borrowers default, banks will face losses. Some estimates suggest $1 trillion in commercial real estate loans are at risk. This is building, slowly, quietly. Just like the 1913 problem built slowly until it exploded in 1914. The smart money is watching this carefully. The insiders are positioning. Are you? We're at about the 2-hour mark now, and I want to take a moment to make sure you understand what we've discovered together tonight. We've traced a pattern through 110 years of history. 7 major crises: 1914, 1929, 1944, 1971, 2008, 2020, 2023. Every single time, the same playbook. Banks create instability. Crisis threatens them. Emergency justifies intervention. Public resources rescue private institutions. Banks emerge more powerful. The system concentrates. And the stage is set for the next crisis. The pattern is undeniable. The consistency is absolute. And the implications are terrifying. Because if the pattern has repeated 7 times, it will repeat an 8th time. The question isn't whether another crisis is coming. The question is, what emergency will justify it? What will be the 2025 or 2026 equivalent of World War I, the Great Depression, Bretton Woods, the Nixon shock, the housing bubble, COVID, or regional bank failures? What crisis will provide the political cover for the next massive bailout and consolidation? Let me show you what I think is coming, based on the pattern, based on the warning signs, based on what the insiders are doing right now. First, recognize that the system is more fragile now than at any point since 1913. The leverage is higher. Derivatives exposure exceeds $600 trillion in notional value. That's roughly 8 times global GDP. A small percentage of defaults could create losses larger than government's ability to absorb. The interconnectedness is greater. Every major bank has exposure to every other major bank through derivatives, repos, and interbank lending. One major failure could cascade through the system in hours. The central banks have less ammunition. Interest rates are already low by historical standards. Balance sheets are already massive. The tools used in 2008 and 2020 are largely exhausted. Second, the warning signs are visible to those watching. Bank executives are selling stock. Jamie Dimon, CEO of JP Morgan Chase, sold over $140 million of personal stock in 2023 to 2024. His first significant sale in years. Why? If he's so confident in his bank and the system, why sell now? Other banking executives have made similar moves. The insiders are reducing exposure. Regulators are granting quiet exemptions to capital requirements. After the 2023 regional bank failures, implementation of Basel III capital requirements was delayed. Banks lobbied intensely to avoid having to recognize their true capital inadequacy. The Fed has restarted balance sheet expansion after attempting to reduce it. The Bank Term Funding Program and other facilities are growing. Support is increasing again, quietly, while the public isn't watching. Third, geopolitical tensions are rising in ways eerily reminiscent of 1913 to 1914. US-China tensions over Taiwan are escalating. The Ukraine war shows no signs of resolution. Middle East conflicts are intensifying. These aren't random events, they're potential triggers. Just like the July crisis of 1914, any of these situations could explode into a conflict that provides the perfect justification for emergency financial measures. Think about what governments could do under cover of war. Capital controls, gold confiscation, central bank digital currencies, forced conversion of assets, all justified by national security emergency. Fourth, the pattern is accelerating. The time between crises has shrunk from decades to years. 1914 to 1929, 15 years. 1929 to 1944, 15 years. 1944 to 1971, 27 years. 1971 to 2008, 37 years. 2008 to 2020, 12 years. 2020 to 2023, 3 years. The pattern is speeding up. The next crisis won't be decades away. It won't be a decade away. It's likely within the next 2 to 5 years, maybe sooner. The math doesn't work. The system can't continue. Something will break. And when it does, the response will follow the pattern. Emergency, bailout, consolidation, but bigger than ever before. Fifth, the next crisis will likely involve central bank digital currencies, CBDCs. Governments and central banks are developing digital currencies that would give them complete control over money. Every transaction visible, every purchase tracked, the ability to freeze accounts instantly, the ability to impose negative interest rates, the ability to program money with expiration dates or restricted uses. This technology is ready. What's missing is the crisis that justifies its implementation. Just like the Federal Reserve was ready in November 1914. Just like the Bretton Woods system was ready in July 1944. The infrastructure is built, waiting for the emergency. Sixth, the consolidation will be the largest yet. After 2008, 5 banks controlled 45% of assets. After the next crisis, it might be 3 banks, or even 1. The trend toward concentration is clear and consistent. Every crisis eliminates more small banks. Every crisis makes the survivors larger and more systemically important. The endgame of this pattern is a financial system where a handful of mega banks or perhaps a single global banking entity, controls all credit creation. Combined with CBDCS, this would give unprecedented control over economic activity. Every transaction monitored, every purchase approved or denied. Financial freedom would cease to exist. Now, you might be thinking this sounds dystopian. It sounds like conspiracy theory. But here's what you need to understand. I'm not predicting some grand conspiracy. I'm extrapolating the pattern. The pattern is what's real. The pattern has repeated 7 times. Each iteration removes more freedom, concentrates more power, and transfers more wealth. The next iteration will continue that trend. Not because evil bankers are plotting in secret rooms, but because the system has its own logic. The logic of consolidation through crisis. The logic of power concentrating at the top. The logic of emergency justifying anything. So, what do you do with this information? How do you prepare? First, understand that bank deposits are not money. They're promises. Legally, your deposit is a loan you made to the bank. The bank owes you, but the bank doesn't have your money. It lent most of it to others. If the bank fails, you're an unsecured creditor. FDIC insurance covers $250,000, but insurance funds are tiny relative to total deposits. In a systemic crisis, the insurance runs out fast. Real security means holding assets outside the banking system. Second, recognize that inflation is theft. When central banks print money, they create inflation. Inflation reduces the real value of fixed currency. Your savings lose purchasing power. This is how bailouts are really funded. Not through visible taxes that voters can reject, but through hidden inflation that most people don't understand. Holding cash or bonds means accepting this theft. Holding real assets, things with intrinsic value that can't be inflated away, provides protection. Real estate, productive businesses, commodities, things that maintain value regardless of currency manipulation. Third, diversify across jurisdictions. The pattern has been national or regional, but it's moving toward global coordination. The next crisis might involve coordinated central bank actions worldwide. Having assets in multiple countries, multiple currencies, multiple legal systems provides some insulation. Not perfect, but better than having everything in one system that could be frozen, confiscated, or inflated away. Geographic diversification is like insurance. You hope you never need it, but if you do need it, you'll be grateful you have it. Fourth, maintain practical skills and relationships. Financial assets exist on computer servers and in legal structures that depend on system stability. If the system breaks down completely, as it nearly did in 1914 and 2008, digital wealth might become inaccessible. But practical skills, useful knowledge, and real relationships retain value regardless. This isn't prepper paranoia. This is recognizing that paper wealth and digital wealth depend on functioning systems. When systems fail, other forms of capital matter more. Fifth, watch for the triggers. The next crisis will be signaled, just like 1914 had signals in 1913, just like 2008 had signals in 2007. The signals will be rising counterparty risk, banks refusing to lend to each other, credit markets freezing, and insiders selling assets. We're already seeing some of these signals now. When they intensify, when multiple signals appear simultaneously, that's your warning. That's when you need to be positioned defensively, because once the crisis is obvious to everyone, it's too late to prepare. Sixth, understand that opposing the pattern is futile. You're not going to reform the system. You're not going to stop the bailouts. You're not going to prevent the consolidation. The pattern has too much momentum, too much institutional support, too much political protection. Your goal isn't to fight the pattern. Your goal is to recognize it early and position yourself on the right side of the wealth transfer. The wealth transfer is happening. You want to be receiving, not giving. You want to hold assets that benefit from the pattern, not assets that get sacrificed to the pattern. Now, as we approach the end of our journey together, I want to bring this back to the personal level, because this isn't really about banking history or economic theory. This is about you, your family, your financial security, your future. The pattern I've shown you tonight isn't ancient history. It's the operating system of modern finance. It's running right now, and the next iteration is loading. The question is, will you recognize it? Will you prepare? Or will you be like the generation of 1914, trusting the system and learning too late that the system is designed to transfer wealth from them to banks? The generation that lived through 1914 trusted their banks. They believed in the gold standard. They kept their savings in deposits and government bonds. They assumed their purchasing power was secure. By 1920, they had lost 50 to 90% of their wealth to inflation. The gold backing was gone. The bonds paid in depreciated currency. A lifetime of savings was destroyed. Because they trusted the system, because they didn't see the pattern, because they didn't prepare. The generation that lived through 1929 made the same mistakes. Trust, optimism, faith in institutions, and they lost everything in the Depression. But some people didn't lose. Some people saw the pattern. Joseph Kennedy sold at the market top. Bernard Baruch positioned for the crash. The Rothschilds prepared in 1913, before the 1914 crisis. These people didn't have better information than you have now. They had better pattern recognition. They understood that the system operates according to consistent principles, that crisis serves banking interests, that emergency justifies wealth transfer, that the pattern repeats, and they positioned accordingly. They converted paper assets to real assets. They diversified. They maintained liquidity. And they preserved their wealth while others lost everything. You now have the same knowledge they had. You've seen the pattern through 110 years of history. You understand the mechanisms. You recognize the warning signs. The question is, what will you do with this knowledge? Will you trust the system and hope for the best? Or will you recognize the pattern and prepare for the inevitable? The choice is yours, but make it consciously. Make it informed. Because the next iteration of the pattern is coming. And those who understand history don't have to repeat its mistakes. Let me leave you with one final thought as you drift off to sleep tonight. The pattern isn't a conspiracy. It's not evil bankers meeting in secret. It's simpler and more profound than that. It's a system that has learned how to use crisis for consolidation. A system that has discovered that emergency overrides normal rules. A system that has realized that the public will accept wealth transfers during crisis that they would never accept during calm. The pattern repeats because it works. It works because crisis creates fear, and fear makes people accept solutions they would normally reject. The system isn't broken. The system is working exactly as designed. Banks create instability through leverage and speculation. Crisis threatens them. Emergency provides justification. Public resources rescue them. They emerge more powerful. The cycle repeats. This has happened 7 times in the last 110 years. It will happen an 8th time, probably soon. The only variables are timing and justification. The outcome is predetermined by the pattern. Crisis, emergency, bailout, consolidation, repeat. Once you see it, you can't unsee it. Thank you for joining me on this incredible journey through financial history tonight. Thank you for your curiosity, your patience, and your willingness to think deeply about how the world really works. If this opened your eyes to patterns you hadn't seen before, share it with someone who needs to understand. Talk about it with your family. Question the official narratives. Prepare accordingly. The pattern is clear for those who choose to see it. The signals are visible for those watching. The next chapter is being written right now. The only question is, which side of the wealth transfer will you be on? Sleep well, and remember, those who understand history don't have to repeat its mistakes. The generation that lived through 1914 learned too late. The generation of 1929 learned too late. The generation of 2008 is learning now. But this generation, your generation, still has time. Time to recognize the pattern. Time to prepare. Time to position. But time is running out. The system is fragile. The warnings are multiplying. The next crisis is building. And when it arrives, it will follow the pattern. As it always has. As it always will. Until the system itself changes. Which it won't. Because the pattern is the system. And the system works perfectly for those who designed it. Rest easy, friend. And when you wake, look at the world with new eyes. Eyes that see the pattern. Eyes that recognize the signals. Eyes that understand how crisis serves power. The world hasn't changed, but your understanding of it has. And that understanding is the only real protection available. The pattern repeats, always, without exception. Those who see it survive. Those who don't. It's that simple and that brutal. Sleep now. Dream of a world where this pattern no longer operates, but wake to the world as it is and prepare accordingly. The next chapter begins soon, very soon, and you'll recognize it because you've seen this movie before, 7 times. You know how it ends. The only question is, will you be ready?